Welcome back to our channel, where we will be diving deep into the terminologies that are essential to help you get ready for your financial certification exams like investment funds and Canadian securities. Whether you're gearing up to tackle your exams head-on or just looking to boost your financial vocabulary, you're in the right place. Don't forget to hit that subscribe button and ring the notification bell, so you never miss an update from us. As always, remember to like, comment, and share your thoughts. Now, let's begin. Equity securities. Equity securities are financial instruments that represent ownership in a company. When an individual or entity holds equity securities, it signifies that they have a share of ownership in the company that issued these securities. These ownership stakes are typically in the form of shares or stocks, and they give the holder certain rights, such as the right to vote on company matters and the potential to receive dividends or participate in the company's financial performance. Equity securities are a fundamental component of the financial markets and are traded on stock exchanges, allowing investors to buy and sell ownership stakes in various companies. Equity value per common share. Equity value per common share, also known as book value per common share, quantifies the net asset coverage available for each common share in the scenario where all assets are sold and all liabilities are settled. By dividing the total equity by the number of common shares outstanding, this ratio provides insight into the intrinsic value of each share. It is a valuable tool for assessing whether a stock is trading below or above its book value. Escrowed shares. Outstanding shares of a company which, while entitled to vote and receive dividends, may not be bought or sold unless special approval is obtained. Mining and oil companies commonly use this technique when treasury shares are issued for new properties. Shares can be released from escrow only with the permission of applicable authorities such as a stock exchange and/or securities commission. ETF facts. ETF facts are concise disclosure documents that ETFs are mandated to create and submit. These are summary of key information such as its investment objectives, fees and expenses, performance history, and risks associated with the fund. ETF facts are designed to be easily understandable by investors and are intended to assist them in making informed investment decisions. They are a valuable resource for individuals seeking to understand the fundamental details of an ETF before investing in it. Ethical decision-making. Ethical decision-making is a process guided by principles such as trust, integrity, justice, fairness, honesty, responsibility, and reliability. It involves making choices that align with these moral values and standards. In this case, individuals and organizations assess the potential consequences of their actions on stakeholders and society as a whole, striving to do what is right and just. It requires a thoughtful evaluation of ethical dilemmas and the consideration of long-term consequences beyond immediate gains. Ethical decision-making is vital in various aspects of life, including business, personal relationships, and societal governance, to promote responsible and ethical behavior. Ethics. Ethics encompasses several meanings, including being a set of rules or standards that dictate the conduct of a specific group or profession. It also refers to a system of moral principles or values that guide individual behavior, influencing decisions and actions. Additionally, ethics can be the academic study of moral principles and the examination of moral choices made by individuals in society. Overall, ethics plays a fundamental role in shaping moral conduct and fostering responsible and principled behavior in various contexts. Eurobonds. Eurobonds are debt securities issued in a currency different from the issuer's domestic currency. They are typically sold outside the issuer's home country. For example, a Japanese company issuing bonds denominated in US dollars in London would create a Eurobond. These bonds are subject to international regulations and provide diversification opportunities for investors. European-style option. A European-style option is a type of financial derivative that allows the holder to exercise their option only on a predetermined expiration date, which is usually the business day just before the option's expiry. This contrasts with American-style options, which can be exercised at any time before or on the expiration date. European-style options are prevalent in European markets and can help manage risk or speculate on price movements in various financial assets. Exercise. Exercise refers to the action taken by the holder of an option or warrant contract to utilize the rights granted by that contract. When an option holder decides to exercise their option, they are essentially acting on the terms of the contract. Exercise price. The exercise price, also known as the strike price, is the specified price at which a derivative contract, such as an option or warrant, allows the holder to buy, in the case of a call option, or sell, in the case of a put option, the underlying security. This price is predetermined when the contract is created and remains fixed throughout the contract's term. It determines the price at which the derivative holder can either acquire or dispose of the underlying asset. The exercise price is a crucial element in the valuation and execution of derivative contracts. Expansion. Expansion is a phase of the business cycle marked by rising corporate profits, increased share prices, growing demand for business investment capital, and higher interest rates. It signifies economic growth and optimism but can also lead to inflationary pressures. Expansion typically precedes a peak and may eventually transition into a contraction phase in the business cycle. Expectations theory. The expectations theory posits that the shape of the yield curve is determined by market expectations regarding future interest rates. If investors anticipate higher future interest rates, the yield curve tends to be upward sloping, and if they expect rates to decline, it becomes downward sloping. It's one of the theories used to explain the yield curve's behavior. Expiration date. The expiration date is the specific day when certain rights or option contracts come to an end. In the context of equity options, it's typically the Saturday following the third Friday of the contract's listed month. On this date, the options become invalid, and holders lose the right to buy or sell the underlying asset. The term expiration date can also apply to warrants and rights, indicating the day they cease to be valid or tradable. Ex post. Ex post refers to the actual rate of return that has been realized on an investment. It is based on historical data and reflects the real performance of an investment over a specific period. This contrasts with ex ante, which represents expected or projected returns before an investment is made. Ex post returns are important for evaluating how well an investment or portfolio has performed compared to initial expectations and for assessing its historical performance. Ex rights. Ex rights is a term used to indicate that the buyer of a common share is not entitled to participate in a rights offering associated with that share. Common shares go ex rights 2 business days before the shareholder record date. This means that if you buy shares after the ex rights date, you won't receive the rights to purchase additional shares at a specified price as part of the rights offering. Ex rights trading allows existing shareholders to benefit from the rights offering while new buyers do not have that privilege. Extendable bond or debenture. An extendable bond or debenture is a fixed income security that offers investors the flexibility to extend its maturity date by a predetermined number of years beyond the original maturity date. This feature can be advantageous in uncertain interest rate environments. When the extension option is used, bondholders continue to receive interest payments and can potentially hold the bond for a longer period. This flexibility allows investors to adjust to changing market conditions and potentially benefit from higher yields in the future. Extension date. In the context of extendable bonds, this refers to the specific date on which the maturity of the bond can be extended. This extension allows the bond to transition from being a short-term bond to becoming a long-term bond. Investors have the option to exercise this extension feature, typically at predetermined intervals or dates, in response to their investment preferences and market conditions. It provides flexibility to bondholders by potentially lengthening the investment horizon and adapting to changing interest rate environments. Extra dividend. An extra dividend is an additional payment made by a company to its shareholders on top of the regular dividend distribution. This payment is typically made when the company has generated higher than expected profits or has excess cash that it wants to distribute to shareholders. As we wrap up this session, we're thrilled to have embarked on this journey together, exploring the foundational terminologies crucial for acing your financial certification exams, including investment funds and Canadian securities. If you found our insights valuable, remember to show your support with a thumbs up and extend the knowledge to your fellow learners. We trust that these insights will prove indispensable on your road to success. Stay tuned for more enriching content, and remember, your financial expertise is just a click away.